Good afternoon, all, and welcome to our last webinar for this financial year. Our focus today will be on our property portfolio. My name is Ben Narcissus, and I'm the Director of Distribution at TAMIM Asset Management. Today, I'm delighted to be joined by both TAMIM founders and directors, Jeff Taitz, who heads TAMIM Property Side, and Darren Katz, who heads TAMIM Credit and Equity Investments. I know some of you already heard this, but always we have new people joining, so we'll make a quick introduction. Before we dive into the serious stuff, let me tell you a fact about my background. I've had the pleasure and sometimes the chaos, to be honest, of living in 8 countries. Speaking of experience, I also speak 5 different languages. My kids make fun of me speaking 3 of them in one sentence. I'm not even talking about my accents. In my role at TAMIM, I've had the opportunity to chat with many of you. And for those who I haven't, I hope I will soon. My international experience have demonstrated that the principle of sound investment and strong relationships are universally valued, regardless of the location. For us at TAMIM, we do not only believe in good investments, but who you are doing investments with is certainly not less, if not more important. All right, enough about me. At the bottom of your screen, you'll find space to raise any questions during the webinars. Jeff and Darren will be more than happy to address them at the end. Also, be aware that the webinar is being recorded and we will send the recordings in the next few days. The disclaimer, we put this at the beginning of each of our webinars, just as a reminder that this is not specific advice to you, but rather general advice only. Sorry. For those who may not be familiar with TAMIM Asset Management, allow me to give you a brief introduction. TAMIM is a boutique investment management firm overseeing just over $220 million on behalf of approximately 515 clients. Our primary goal is to generate returns for our investors by offering unique and differentiated investment opportunities that provide significant diversification to the existing portfolio. Our investment focuses on 3 key asset classes: equities, property, and credit. Within the equity category, we offer both Australian and global investment solutions. Our Australian solutions include the small cap and the all cap funds managed by Ron Shamgar. Ron Shamgar has run our Australian all-cap portfolio for just over 5 years and has annualized 17.1% net of fees through that period. This puts him in the top 5 Australian equity managers over that period, according to Morningstar. The standout for me is that $1 million investment made 5 years ago would now be worth 2.4. On the global side, we have the Global High Conviction Fund managed by Robert Swift. This fund has achieved a 1-year return of 23.1% and 13.6% since inception. Both numbers are net of fees. We also have the Mobility Fund, led by Ryan Mann. The fund focuses on technology with a transportation focus. Ryan joined TAMIM team in November 2023 after serving as partner at Ibex, running the same mobility long-short equity fund. Since his arrival, the fund performance has improved significantly, reaching a return of 13%. Our credit fund focuses on private debt investment solutions and has performed exceptionally well. With only 1 negative month pre-COVID since inception 6 years ago, the fund aims to generate on a forward basis over the forthcoming 12 months a 9% return for investors net of fees. Last one is the listed properties. The portfolio consists of listed real estate securities split 50-50 between Australian REITs and global REITs. If you didn't have time to attend or register for any of our webinars we have already run, our global mobility, credit, global equities, and Australian equities recordings are also available upon request. With that, I will now hand over to Jeff Taitz. Welcome, Jeff. We look forward to hearing your insight today.
Great. Good afternoon, everybody, and thank you for joining us. In today's presentation, I'd like to cover off on the following 4 key ideas: the how and what we have done to date in direct property, interest rates and what it does to property, how lenders see the market, and where we see opportunity and value in exploring that further. When it comes to investing in direct real estate, TAMIM is opportunistic. We like slightly unloved multi-tenanted assets. If the asset is defensive, has a defensive character, it's even better for us. We tend to like sites that others find difficult or challenging to manage, but in which we can see potential. And when it comes to sector and geography, we are agnostic, but we do find that we like the sector and everyone else seems to dislike. So I guess it would be accurate to describe us as counter-cyclical. In terms of our investment philosophy, it's pretty simple. Rule 1, we want to preserve investor capital. Rule 2, we want to earn an appropriate yield or income for the risk taken while we own the asset and wait for the capital appreciation. And Rule 3, we go back to Rule 1, which is preserve investor capital. If we move on to the investment process, before buying an asset, we like to take aim at an asset, which is spelled slightly differently. We spell it AME. And what this means to us is before buying an asset, we seek to understand the asset well and acquire it at the right price. We focus on the effective management of an asset during ownership, and we identify where we can add value and can be monetized through a successful exit. The best way to elaborate and explain this is to go through some examples of what we've done to date. These all being different asset classes. So I might start with the first asset that we acquired, which is a office building back in February 2022 in Adelaide, just after COVID, when everyone was quite against office and very pessimistic on the outlook. This was a 9,000 square meter building. It was 50% leased. It had a stigma in the market that it was not able to be leased. We took on this asset, and within 18 months, we had increased the occupancy. The value came here as we found the floor plate from the previous manager was a 900 square meter floor plate, which was easily carved up into smaller spaces. This allowed us to actually move to the SME market, which would be able to do lease transactions much quicker. So instead of having long lead times, we were able to bring it down to 2 to 3 months, where leases could be executed quite quickly. And we provided turnkey solutions for tenants, making it very easy for tenants to walk into an asset and actually sign a lease. So the asset currently sits at about 94% leased today. The current market in Adelaide is roughly about a 17% vacancy factor, so we're outperforming the market and travelling very well. The other value add that we've done to the asset in the last little bit is we've taken one of the floors and converted that into a serviced office offering. What this has done is it's provided us with a further depth of the Adelaide market, where we're able to offer up to 29 smaller suites, which has created a lot of demand for leasing activity. So we find we're getting a lot of leasing activity into the market, which has actually resulted us in having a significantly higher occupancy compared to others in the market. If we move on to the next asset class we've looked at, which is the TAMIM Property Fund large format retail in Rutherford. This was an asset we acquired in December 2022. This was an asset that was an old master store that had been reconverted into large format retailing quite effectively. What we found was that the asset lacked a food offering on site, and it just made it very untenable for patrons and shoppers to be on the site for longer than 45 minutes. So by putting in a food offering and discovering, as I said, it was a master store and had built-in grease traps and the like, we were able to introduce the food offering quite efficiently, and that has enhanced the asset significantly. In addition to this, we've enhanced the yield and revenue by enforcing percentage rent clauses through the leases, which has really turbocharged the asset and returns to investors. The last value add we've done is installing solar panels onto the roof for tenants and for the centre, and the cost has been recovered within a 2-year payback period, which is pretty quick. But not only that, the spend has resulted in a 4 times increase in the cost of the spend in terms of asset value by a reduction in outgoings that has resulted from the asset. So we've enhanced the asset by spending capital in the right places, and that generates quite a strong effective yield for investors. So again, the occupancy is 100%, which is obviously allowed these assets to be quite robust even in changes with interest rate environments. The third asset I'd like to talk to is the TAMIM Property Fund Fairfield Heights. This is primarily a standalone Woolies centre with 2 specialty leases. When we acquired the asset, this was just before COVID, we had a sneaking suspicion that the zoning and density in the area here would change. And I suppose with the assistance of COVID, this was accelerated, and within 12 months, it went from a zoning of 3 stories to 8 stories, which allows significant density, and land value is almost tripled on this asset since we're acquiring it. So a very successful asset to date, really long leases, and really a good quality asset to manage. The last asset I wanted to speak about is the the Elmore Vale property. This is a shopping centre asset just outside Newcastle, 8 kilometres from Newcastle. It's one of the first assets we acquired, and we've actually exited this asset. It's generated about a 14% return IRR, so internal rate of return to investors per annum over the period. This is quite a challenging asset to manage, and obviously the first asset we took on. So things that we did on this asset while we owned it was increase floor space by 5% and lodging a DA in the short time we owned it. We repositioned and redecorated the asset so that it would present incredibly well. And we operated this asset obviously through COVID very successfully without losing any tenants and still collecting more rent. What we did discover in the more rural areas or outlying areas is that tenants are quite happy to be paying smaller rents, so they don't require large shops. And by cutting up the larger space into smaller spaces, we were able to actually lease the centre quite well and effectively. I suppose the war story that comes out of this asset is we had a news agent and post office that did not want to continue his lease, and it would have been an essential service that got lost from the centre. So we decided to actually take over and operate the post office, news agent and lotto shop and build the business up. This is a business that was originally doing about 1.2 million of turnover. We grew that to roughly double, about $2.5 million of turnover, signed a new 5-year lease, and found a third party who wanted to run this as a business and sold it as a business. So this is obviously is what we do with assets. We're interested in running the centres, not running the businesses inside them, but it means we have the abilities and the skills to actually operate businesses inside the centres to generate that return for investors if need be. So if we move on to, I suppose, item 2 of the agenda, which is just to understand what's happening with interest rates. Interest rates, as everyone knows, is one of the biggest drivers of property prices, in my opinion. Everyone understands that when interest rates go down, property prices increases, and when interest rates go up, property prices will fall. So if we're looking at this chart, you can see interest rates are currently sitting at 4.35, the current RBA rate. And if you put that into a bit more context, if you put that into a bit more context, what we find is the average rate from 1990 to 2024 has been an average of about 3.86%, with an all-time high of about 17.5% in 1990 and an all-time low of 0.1%, which we've all experienced in 2020. So we're currently in the territory right now where rates are above, if you want, a 35-year average or 34-year average, which means it would seem to us that you're at that change in the cycle where property starts to become very interesting once again, and opportunities should provide itself. And I suppose the reason why interest rates have such a huge impact on property prices is that property is normally geared and would have some debt associated with it. And that obviously would result in loan to value ratios or income cover ratios, which need to be maintained and by borrowers. Otherwise, if those are breached, then it will actually bring property to the helm. And you might find that's when forced sales would need to happen, and you find vendors will be required to actually trade the asset. So to date, we found there's been quite a lack of property on the market, with the expectation now that interest rates look like they might be coming off. We're finding that the transaction volume has really thinned out. And what I'd like to do is I'd like to just look at, I suppose, the figure 2 on the screen here, which is the left-hand side of the graph here, which provides a lender sentiment survey of what the expectation is of what the RBA rates will be doing. And just to expand on this, so this survey is a survey that was done about a month ago between 40 respondents, and 40% of those would be domestic banks, 28% would be international banks, and 33% would be non-bank or private lenders. And what this is sort of directing you towards is that 57% of those respondents, which is indicated by the dark blue bar graph, in terms of what they are projecting over the next 6 months, are saying that rates are likely going to be staying at the 4.35% rate. And if we look out even 6 months to June 2025, we'll find 50% are expecting that there will be a 25% rate cut, is the expectation. So I suppose that just gives a bit of detail in terms of what lenders are thinking out there. The chart on the right does actually give you a forward projections in terms of or forecasts of what the major big banks are doing. So the ANZs, the CBAs, the NABs, and the Westpacs, in terms of their expectation, they're all are showing a decline or a reduction in rates over the next 12 months. If we move across into margins and moving on into lenders' expectations of credit margins, of movement and interest rate requirements, figure 4 depicts that 70% of lenders expect the cost of borrowing to remain stable, and therefore the cost of debt to remain flat, meaning that there's no increase or decrease in the cost of borrowings. And then figure 5 is showing us that there's a change in the last 6 months where 60 to 67% of lenders hedging requirements has reduced from over 50% to less than 25%. So once again, these things are just fairly quick graphs just to give you a quick snapshot of what lenders are seeing and what lenders are thinking out there. Again, here we see again a shift over the last 12 months in terms of lending ratios, where lenders tending to reduce the interest cover ratios, which is really the serviceability measure of debt, from the 1.5 times to 1.35. So you find they're relaxing that, and the loan to property value is also increasing to over 60%. So lenders are acknowledging that property values have reduced, and as a result, they have become a bit more lenient in terms of the requirements when actually writing terms and conditions for doing new borrowings. Of interest is this, of this chart you find is industrial property has become the preferred asset class as a result of record low vacancy. So this is telling you that, over 70% of industrial assets is where lenders actually prefer their borrowings to be because of that low vacancy factor. And if you look into this chart, you can see retail and office is starting to increase again and starting to show signs of activity. In terms of lenders' appetite for refinance, figure 14 highlights that the 3 main variables that are impacting lenders' appetite for refinancing assets is leverage or debt to equity ratios, the asset type, and vacancy. So those would be the main factors that come into play. So if we move along now and we're looking at property transaction levels over the last few years and how the background of interest rates and lenders' appetite for loans from the last few slides, this is what we get to see. So the chart on the right-hand side here, which is your quarterly commercial real estate investment volume, what this is showing you is over the last 6 years, the volume of transaction going through the market is actually reduced quite dramatically. The dark blue legend in the chart represents the office component, and you can see it's actually reduced significantly over the period. Historically, over the last 20 years, office has been about 53% of all property transactions. So you can see it actually has reduced quite considerably. In terms of where we see opportunity and value, for us, it's more in the retail space and the office space. Retail has been very consistent and steady, and office space, because the low volume is becoming very attractive to actually get some transactions done. So you find the vendors are actually reducing prices to start to meet expectations of the purchasers. So if we look at the chart on the left-hand side, this provides us the office market overview for Q1 in 2024. What we can see is that the volume of transaction is roughly $1.3 billion of transactions across 25 office assets for the quarter. From 2022 to 2023, there was a 72% drop in activity. So it is definitely a reducing trend and definitely a category that is not trading in the market. So we see opportunity in the office, and obviously when we talk office, the major concern is the back to work myth that I think I need to address, which everyone likes to look at when we talk about office assets. And there are 4 key items that we would look into whenever we look at any property. The first one being the future supply in terms of the new stock coming onto the market. The second item would be the gross effective rent in terms of what they are doing. 3 would be the vacancy factor that comes through the market. And the 4th would be the economy and how's that going. And when these all align, it becomes the right environment for property. So I suppose I've been searching around to try and get some data on the return back to office, and this is what I was able to come with. So what these slides all assume is that pre-COVID, everyone worked from the office 100% of the time, because no one really measured it. And what this graph is showing you is that we were able to get some information in terms of what's happening as the average occupancy through Australia. And you can see that line, it starts off relatively low, below 20%, and then it climbs up to 76%. So the occupancy back in capital cities has climbed significantly and has improved significantly. In the US, you find that's not quite the case. That's still trading at about 50%. So it is a very different scenario. And we'll say Australia and America are not alike in this format and are very different. If we actually go one step further and we drill into that in a bit more detail and break it down by capital city, what we can see here is that Adelaide traveling really strongly, 88% as being the weekly average occupancy, having peak days of 94%. So really, really strong commitment and people coming back into the office. Perth incredibly strong at 93% and 96%, followed by Brisbane and Sydney. The interesting thing about these slides is you'll find the gap between the peak day and the average weekly occupancy is actually narrowing and reducing as time goes on, which means more and more people are working from the office and there's no longer work from home. So it looks like it's going to become a thing of the past at some sort of a stage. In terms of one of the other things we like to consider, this slide provides us a breakdown of future supply pipeline by city for the next 2 years, as well as what we consider when this sort of thing happens is what secondary or refurbished space that will come back onto the market after these sort of events. So you can see from the slide here that anything from 2 to 5.5% is pretty much the volume of new stock coming onto the market, with obviously Sydney and Melbourne having the most amount of stock coming on in terms of square meterage, which is quite huge. The interesting thing to note here is that the pre-commitment for Sydney and for Brisbane is over 50%, where the others aren't. And what we'll find is the average rents would be reflective of this when we look at the next slides and further details. So if we move on to the next slide, and I do apologize, it is a little bit small, and there's quite a lot of information to go through. The first slide in the very left-hand corner gives you a breakdown of the net supply, vacancy, and net absorption. So the blue chart in the line is showing the amount of new supply coming on, and this is really nationally. So this is right across the whole state. So you can see that is definitely increasing. The net absorption is showing you the amount of actually new space taken on and new leasing deals done. And the interesting one is the vacancy, which is the line through the middle, is showing you vacancies climbing slowly up to about 14.2% currently. So vacancy is tracking upwards, but not at any alarming levels by any means, which means everything is still in order and still intact in the office sector. If we move it to the right of this graph, you've got the national weighted average net effective rents, and we can see here that the prime net effective as well as the B grade net effective is very stable. The rates aren't bouncing around or dropping significantly, even with the amount of volume coming onto the market, which tells you that it's still operating, still working, and there's definitely a case for the office category or office asset in the market. Sales volume we've already spoken about. We've just covered that in a previous chart, and I'll just move on to the national weighted average yields. So this is just showing you that office at one stage became relatively expensive. The yields did compress quite a bit with interest rates coming off. Now that rates have started to move up, those rates are starting to head upwards and they're starting to become interesting once again. So as those yields move up, it starts to become attractive to us once again, and that's obviously why we started looking at office once again. If we drill into the detail in terms of, for example, the gross effective rents by CBD, this also paints a slightly different picture where you're looking at a national basis, it all looks pretty steady and static. But when you actually break it down and start looking into each individual city, you start to get very different stories happening. And this is obviously driven by the amount of supply coming onto the market. What we do find is You've got favourable results coming through for Adelaide, Brisbane and Canberra, and more unfavourable changes happening in Melbourne and Sydney. So there you find your rates haven't actually reached pre-COVID levels and are still well below. Melbourne obviously looks like a little bit of a basket case when it comes to office, and the outlook doesn't look very favourable. So it just paints a picture. So the markets we would be very comfortable to look in would be the Adelaide, Brisbane, Canberra. Sydney could be of interest if you're buying the right asset at the right price. Behind property, we always like to look at the economic snapshot in terms of what's happening out there in the economy. We've got all positive things happening in the economy. The biggest one obviously being population growth. As long as population growth is moving, there's always going to be increasing demand. The unemployment rate is at historic low levels and inflation traveling really low at 4%. So we always need to be more mindful of the forces in the economy at all times, which brings me to the end of my presentation. I hope I've been able to share some ideas with you and given you much to think about and take away from today's presentation.
Jeff, thanks so much for that. It's always good to sit in the office with you and listen to you talk. Certainly, I know when we discuss property, you're probably one of the smarter, more clued up individuals when it comes to this asset class that I've come across. And although probably comes with a bit of bias, being your business partner, certainly watching you operate across the asset class, to us there does not seem to be that many people out there in Australia that would match the ability that you and your property team have. So always good to hear the insights. Before I head across to questions, and I'm just going to remind people, I can see there's a few questions in the screen already, but if you look on the bottom of the screen, there should be a Q&A button for you to click into. You can ask your questions there. So while I'm talking here for the last few minutes, maybe if you have any further questions, just click on the button and pop them into the screen. When we talk about investing, there's generally two key areas that we always want to focus upon. We invest primarily for one reason, and that is very much to generate a return for ourselves or our retirement or for the future. And essentially, when we look at this particular asset class, and in particular TAMIM's investments across single asset properties through the years, we certainly see a very strong ability to identify assets that will generate strong income as well as have really strong capital upside. And certainly if I look at the Ellamore example, which was our first asset acquired within this business and obviously the first asset disposed of, the yield through that across 5.5 years, exceptionally strong, even taking into account COVID, and then the capital upside that was achieved through that transaction on the sale, really strong, with investors coming close to pretty much doubling their investment across that time frame. The interesting thing that people tend to not pick up on that as well is that the returns through these syndicated individual property transactions tend to be very tax effective. So always good to remember that when we talk yields to our investors and clients, generally that's going to be a net of tax or an after tax basis. So always good to bear that in mind. Alongside the return side, though, that's only half of the conversation from our perspective. We also say that we want to be focusing on being able to generate returns in a way that is very different to the rest of the assets that you would hold in your portfolios. And certainly you see that across these property holdings. Most of our investors and probably most people out there would have a combination of equities in their portfolios alongside fixed income and credit, and adding property or having the ability to add property into that mix not only delivers a strong set of returns, but also those returns in a different way. So ultimately, through diversification, you're bringing your risk levels of your portfolio down. So certainly, those two key factors are what we consider really important when investing. I know we always talk about looking for assets that other people don't want to be invested into. And I know we also talk about looking for assets that are slightly more difficult to manage because we think that we can deliver upside from that. But return and diversification through different return profiles is important. So with that, I might stop talking, given that obviously there are no specific investment transactions on the horizon at the moment. And that actually probably segues us quite nicely into the first of the questions that I can see on the board today. Jeff, I don't know if you want to maybe just comment on this. We're about 2 years since our last transaction. Looking at the market today, obviously interest rates have spiked quite dramatically. What does the outlook look like from an ability to pick up further property transactions? And the second part to that question is, what are you seeing there in different sectors? Are we going to be looking to, do you think the next asset will be an industrial asset, a commercial asset, a retail asset? Where do you think the opportunities are likely to come over the next 12 months?
Thanks, Darren. Look, it's a very difficult question. What we're finding is the transaction volume has definitely reduced and dropped down significantly. Sorry, I've just got a little bit of an echo. Yeah, there we go. So we're finding vendors are not actually bringing property to the markets. There are a couple of assets floating around which have come around 2 or 3 times. It's the same assets looking for a home. The vendors each time around become a little bit more realistic in terms of their pricing, but don't really quite get to where the market's at and meet the market. Property is a patience game, so we're not going to take an asset for the sake of taking it just to do a transaction. We want to make sure the next asset we acquire is an asset we want. It's bought at the right price, and it's going to generate us a return for the risk we're prepared to take on. So unfortunately with property, we don't know when it will happen. We do canvass and do look at, I would say, 3 to 4 transactions a week still. A lot of them are coming to us off market at the time. It's just a matter of being really particular of the assets you're looking to take on and the value we are able to extract or create from the asset. So we are open to all types of assets. We're seeing far more opportunity in the retail space at the moment and even in the office sector. But as I said, a lot of the vendors don't want to take haircuts if they've actually acquired the assets in the last 3 or 4 years. And with the expectation of rates looking like they were coming off, up until yesterday, a lot of assets have been withdrawn from the market. And what we find is when interest rates start to move, it actually starts to create opportunity. So we don't expect interest rates to move very much, but I'm always hopeful that rates go higher because it just creates opportunity. Not to say that it will happen.
A little bit of a funnier question here. One of the participants in today's webinar says they have an industrial shed that they own and they'd love to sell it to you. You interested in buying industrial?
Look, industrial is a very interesting asset class. It's trading at, as I said, the vacancy factor in industrial is incredibly low. So you find people are paying quite aggressively for industrial. Industrial is a very expensive asset. Industrial, to me, the reason why you buy industrial is that there could be a conversion to resi at some stage, and that's why you're prepared to actually hold it. Industrial is a lumpy asset. It's large parcels of lands. So yeah, it comes with a very different risk profile. I think a lot of investors forget the risk profile with industrial from a cash flow point of view. But yeah, look, at the right price for the right yield, we'll be open to all asset classes.
There you have it. If you wanted to send us your term sheet, we'd be happy to have a look at it. But knowing Jeff, we're going to be buying it at the right price. So you're definitely not going to be getting top dollar for that purchase. Might just move on to another question here, and this is quite an interesting one. I think the general perception around property is that it's a very risk-free type of investment, and I think partly because you don't see property listed on the stock exchange and you don't see property prices every single day. Looking at property, what do you think are the key risks to be aware of and to be careful of when buying property? What are the things that can really hurt you in a transaction?
That's a great question. With property, sometimes it's the things that you don't expect or the things you can't control, which are the things you've got to be mindful of. So something we can't control is interest rates, but we can mitigate. So that's something we can take protection against. tenant risk, those sort of things, we're comfortable taking risk on the asset. I think people need to be mindful that there's always risk in property, because it's, you're not generating a cash rate. The reason why you get a super profit from property is if you're managing it correctly. And property it's an asset that has to be worked. Unfortunately, it's not an asset that just sort of plods along. You've got to actually really work your assets to get these super returns out of them. So you find relying on managers to actually do the heavy lifting doesn't always work. You've got to actually put the energy into it, in terms of, is there a better way to make the asset work? Is there something you can do to actually enhance that yield, and look at it from a different aspect? That's where you do get the super returns and the higher yields. And look, property is an asset that sometimes you find if you can hold it through different cycles, it does recover. So, as long as you're servicing debt, you're managing the liquidity of the asset and the income of the asset effectively and well, then yeah, look, property can withstand different impacts and events, which does make it quite a robust asset to keep and hold.
Thanks, Jeff. There's definitely a lot of news around construction and construction firms failing over the last couple of years across Australia. Would you guys ever look at development or property development? Is that something that would be of interest to the team? And yeah, just interested in your thoughts around that.
Yeah, look, we primarily try and stay away from development work, is the truth. As I said, we like to earn a return that sort of makes for the assets we own and operate. Taking on development work is slightly different. I don't think a lot of investors acknowledge or realize the amount of risk you take on when you take on construction risk. One, you've got to complete the development. Two, you've got to actually get it leased out. Three, you've got to make sure the builder doesn't go belly up. And four, you've got to actually make sure you get the result that you're actually paying for. So there's a lot that goes through that process. Having built and managed a lot of property over the last 20 years, we've decided that's not the game we want to be in. We're happy to take on an asset where we can create value, we can create a DA, but not necessarily actually do that activity or work. We don't believe that's the journey our investors want to go on. When we invest into an asset or a property, we always have skin in the game. We always like to have 5 to 10% of our own cash invested into an asset, and we go through the same risks and reward that our investors go through. So would we want to take on a 20-25% risk profile by taking on development work, earning a 7% return? The answer is no. So yeah, we have to take on risk where we're getting rewarded for it. If it's a particular asset class that does have a component of construction work and it's minor, yeah, we'll take it on. So taking on a fit out or minor works, yeah, we're happy to take on that kind of work. That's part and parcel of property. But when it comes to actually constructing, building something out of the ground from new, we just believe it's a slightly different risk class. Maybe if we had the right partner who was an expert in that, yeah, we would certainly look at that and explore the idea. But for us right now, it's more about income earning assets that generate positive cash flows and good strong yields for investors.
Looks like there's maybe one more question here. Actually, two questions that are just to run through. And apologize, I'm just going to paraphrase this slightly. With your purchases of property, obviously one of the key risks inside of that is interest rates from a cost perspective. How do you tend to look at interest rate risk across property deals, and sort of how do you manage that? What's your experience has been over the last few years?
That's a great question. In terms of interest rate, that's more of a treasury function. So when it comes to property, we like to make sure we're matching long-term debt with long-term assets. So if we're taking a 5 or 7 year position on a property, we will tend to hedge or have interest protection in there at a level that makes sense for the asset to ensure that we're not subject to that kind of risk. So as I said, any risk that we can eliminate that we can't control, we like to take it out. The classic example is in the assets that we held pre-COVID, where interest rates did come off quite aggressively to 0.1%. We saw that as an opportune time to actually put in place income protection for all our properties that were held at the time. And we would have taken, 7-year positions. So sometimes we weren't really concerned about the immediate 2 years after COVID, but heading into COVID, we were concerned about the time after that in terms of what would happen to interest rates after that. And for the 3 assets we held at the time, we would have taken long-term caps or swaps protection to ensure that we were able to actually support the yield we had forecast to our investors over the period. We did this quite effectively. Unfortunately for us, Peel Street was an asset we acquired after COVID, and the yields were already running and quite aggressive, and it didn't make sense to actually take out income protection on the asset at the time. So that is the only asset where we do have currently. We were able to acquire a 25% income protection on that asset until the end of the year, which has given us some cover into this period. But we haven't yet seen the opportunity for interest rates to retreat enough to actually provide us that cover. So going back to the question is, yes, we think managing the debt piece is an integral part of the property. Obviously, servicing the debt is important. We generally tend to keep our gearing relatively conservative, so we like to be below the 50% mark, which keeps the banks happy, which means our margins and facilities are generally quite aggressive and on the lower end of the spectrum, and it just gives us flexibility to actually work and manage an asset quite effectively.
Thanks, Jeff. I can see I've just got sort of two questions here, one of which you'd already answered, just around whether the principals invest into the investment products themselves. And as Jeff had said a little bit earlier, yeah, we do. We will generally take up 5 to 10% of an asset across the principals of the firm. We firmly believe in investing alongside our investors, and if we're not prepared to put our own cash at risk, then surely we shouldn't be expecting you to do the same. So that's already been answered. Last question for you, and then I might just wrap things up for the day. You obviously run a listed property fund. Any thoughts? And certainly, I'm going to just paraphrase here myself, not to ask you about global, because that's not necessarily where you're looking, but thoughts around the local Australian REIT marketplace. Interesting, not interesting? What would be your thoughts be there?
Yeah, great, thanks, Darren. Look, I suppose as I said, interest rates give you an opportunity for vendors to actually release assets where they're actually not able to service debt and costs. What we have found is through the COVID period, a lot of listed REITs in Australia particularly would have gone out and acquired new assets at quite aggressive pricing. They weren't raising new equity into those transactions. They were using debt to primarily finance that. And as a result, they would have taken those assets on. Some of them better than others, and some have huge capacity to actually utilize much larger facilities than others. But what with the REITs, they're very aggressive in terms of writing the values up. So I sort of talk about taking the elevator up when rates come down, and then taking the stairs down when rates come down, or when rates go up. So you find the asset values in there have come off quite aggressively. And if we can't buy the assets directly in terms of direct property plays, then the next best opportunity is to actually acquire the assets online in terms of an unlisted REIT. So we do get opportunity there to actually pick them up at quite good prices where their pricing has come off 30-40%. And if we can't buy the assets, then yeah, we certainly do want to buy the stocks.
Jeff, thank you very much. I appreciate your time today, and thanks for taking the opportunity to answer all those questions for us as well. Really, from my side, just to wrap it up, we've just run what we think is a fairly informative webinar series across all of our asset classes. Today was property. Certainly, we are starting to see some really interesting opportunities in the property market across our desk. We had a transaction which was very close at the beginning of the year, didn't quite get over the line for a number of reasons in due diligence, but we're starting to see property move very close to our target ranges. So keep an eye on the space for the next little while. We certainly do think there'll be opportunities coming shortly. Our favored areas at the moment do tend to be, as Jeff had said earlier, in the retail and office space. I do think if we held industrial assets at the moment, we'd probably be selling them. But yeah, keep an eye out for the next offering from our team. Other than that, thank you very much for joining us today. We really do appreciate your time and the effort to join us. And I will be wrapping up on that note. Thank you very much, everyone.